SanDisk is once again at the center of market attention after a wave of extreme volatility sparked by strong Q2 earnings, a bullish outlook, and a newly extended manufacturing partnership with Kioxia that directly targets one of the most pressing issues in the memory industry: supply. The stock surged more than 10% intraday following news of the expanded supply pact, reinforcing the view that SanDisk is strategically positioning itself to capitalize on booming AI and data center demand for high performance NAND flash. At the same time, the move has deepened an already intense debate among investors over whether the company is in the early stages of a historic memory supercycle or nearing the top of an overheated parabolic run. SanDisk announced that it has extended its long-standing agreement with Kioxia to secure additional 3D NAND manufacturing capacity, a critical step as the industry grapples with tight supply and rapidly rising prices. Market checks suggest NAND pricing has already jumped roughly 80 to 90% in early 2026, driven by hyperscalers and cloud providers racing to build out AI infrastructure packed with high capacity enterprise SSDs. For SanDisk, now operating as a pure play flash memory company, the extension provides greater visibility into production continuity and strengthens its ability to meet multi year commitments with large customers. Investors viewed the agreement as a strong counterweight to lingering concerns stemming from Western Digital's planned secondary offering of 7.5 million shares, which had pressured related memory names and contributed to a roughly 7% pullback in SanDisk shares the prior session. The Kioxia news helped flip sentiment quickly, with pre market chatter across trading forums highlighting SanDisk as a top momentum name, further amplified by a Zax note that grouped SNDK alongside other high flying memory peers. Trading volumes surged, topping 6 million shares by mid morning, as traders and institutions digested the implications of tighter supply, higher pricing, and reinforced manufacturing partnerships. The rally also builds on January's blockbuster earnings report, which underscored accelerating AI driven data center demand, expanding margins, and disciplined capacity management. Still, the stock's relentless ascent has created a sharply polarized landscape. Bulls argue that SanDisk sits at the epicenter of a structural shift in computing, where AI workloads require exponentially more fast, dense storage, setting the stage for years of elevated pricing and profitability. Bears, however, warn that expectations may already be pricing in perfection, and that any hint of easing demand, new capacity coming online, or macro softness could trigger a sharp correction. As a result, SanDisk now embodies one of the market's most heated battlegrounds, a company with undeniable momentum and powerful secular tailwinds, but also a valuation and chart that leave little room for disappointment.
Okay, so this is Wednesday. So this is Thursday, the 12th of February 2026 pre-market session. It's up 6.3 to 6.28%. Okay, this is pretty much the data from yesterday, the 11th. Okay, let's see what we have. Underlying trend, strongly bullish. You know that already. Projections are saying this was initiated yesterday, the 11th. We have 652.69. All-time high is 694. Let's see whether it might even be higher. 694, it might be 700 and some fraction. 725, all-time high, 725. Yeah. Okay, so we've been able to digest the data from this daily chart and some on its 4 hour chart. That's what we have here. Okay, so let's see. Price pressure momentums, they tell us how the moving averages are appreciating or depreciating as the case may be, how they are how they're appreciating or depreciating. Okay. 10-day moving average gaining $1.22 every day, 21-day 195, 40-day $2.5, 200-day 1.82. Strong trend mode on all of them. Trend mode is from 0.25. Critical observation: the accelerating derivatives first and second across all price pressure momentums signal exponential momentum expansion. PPM ones, second derivative at 3.61 suggests the 10-day moving average itself is accelerating at an unsustainable rate. Classic late stage parabolic behavior. Okay, has actually come back from the parabolic. It has retreated from that. This will be parabolic at this sort of levels. Has actually retreated. The fact that we have an extrapolation coming up is an indication that the settings on the algos have reacted. They have adjusted to face the reality, which is that the stock is, to face the regime that's going on right now. So it has been able to calculate a projection. Before now, you can see earlier on it only had 290. You can see that it had 290 as of even when it was at 506, it was still the same 290. But now it has adjusted and started to recalculate upper projections. So the parabolic regime is gradually becoming a bit stale, you know. So the market grid gives us a structure of a structured price range. Here we have a combination of the data from the 4 hour chart and the one from the daily chart. Okay. So current price 599 is not actually 637. Got that not exactly what we have. Okay, sits between okay, okay, may not be that much. This is based on the daily chart because the daily this further extension happened in the post market session. Let's see now, 4 hour here we have. This is what we have. 4 hours reflecting what's going on right now. So intraday structure extension 632.85, 632.81, 35% probability of printing that. Where is it right now? Yeah, has already exceeded that now. It has exceeded everything. It has exceeded everything. Yeah. Okay, trade setup. If you apply this, you may not have succeed. Okay, so this is a mean reversion play thesis, parabolic 10.65% yesterday, extreme volume on extreme volume. Okay, suggest immediate exhaustion. Price pressure momentum derivative shows unsustainable acceleration. So entry will be okay, as I stated that already. Okay, mean reversion play has exceeded all of that. Targets will be, yeah. So well, the targets are 590, 581, 575. So, but in any case, we have a long-term setup despite near-term overextension. The Kioxia partnership and AI data center tailwinds validate a structural bull case. However, coin prices offer poor risk reward. Wait for healthy retracement to value zones. Bullish bias, they buy the pullback zone one, 5552 to 564. I think okay, that would be a tall order. That would be a tall order. 55552. This we're talking about somewhere around here. Somewhere around here? Somewhere around. It's closed yesterday, just slightly above. Yeah, that would be okay. Well, never say never. And then let's see. The targets will be 615 to 625. It has actually exceeded that one. Then second target is 652. Probability is 55%. 685 to 700. Measured move from base, 35%. Stop loss will be 490. Hold period is 4 to 8 weeks. Key risk factors and invalidations. Daily close above. Yeah. Okay. Macro tailwind, macro wildcard, memory sector sentiment shift or Kioxia partnership delays could trigger 20% gap down regardless of technicals. Summary of verdict. Okay. 3 to 7 days, the 5% probability of a reversion to 575 to 590 range. Coin prices are statistically stretched beyond their two standard deviations from all key moving averages. Intermediate outlook 3 to 6 weeks, 70% probability of testing 531 to 552 support complex before resuming uptrend towards $60, $650. The question isn't if a pullback occurs, but how deep. Strategic recommendation: avoid chasing at current levels. Either fade the parabolic move short term, higher risk, quick profit. Exercise patience for 530 to 560 re-entry zones to participate in the structural bull case with a favorable risk reward. Daily grid breakout above RXT suggests the memory supercycle narrative has legs, but prudent traders let physics gravity work first. Okay, so I'll definitely continue to update you. If it means I'm going to update you in the regular session of concerning SNDK, I'll do that. So see what you make of the stock, and thank you very much for watching this video.